Welcome back, my students, to another course of Mo Money School, the school that teaches you everything that your school should have taught you. I'm your professor, Chris Mo, and for today's class, I'm going to go ahead and teach you the determining factors of what's inside your FICO score. As I mentioned before, your credit score is really important. You want to know exactly how can you build it, what's inside it, and how can I not mess up. Now, in order for you to do this, you want to go ahead and see this video, because each of these factors have a certain percentage that go ahead and boost your credit score. That way you know exactly how you can fix it and how you can boost it. So when it comes to getting approved for a loan, getting approved for a car, or getting approved for a mortgage, you know exactly how you can use it to your benefit. It was a little tricky when it came down to actually figuring out what makes a FICO score, what's a certain percentage, but when I looked at all the research and I found exactly what I possibly could find, this is what I came up with. Now, I may or may not be right. There's a lot of people who have similar findings. There's a lot of people who go ahead and have a different proportion when it comes to each factor. At the end of the day, we each have the same determining factors, and we understand that they each play an important role when it comes to building your credit. So for the first determining factor I want to go over with you guys is your payment history. Your payment history holds a 35% of your credit score. Now, what does this consist of? What is it? It means basically paying your bills on time. How often are you paying your credit cards? How often are you paying your loan? Majority of us fall off the wagon. We don't pay our bills on time. We are months behind. Something happens in life, and now this percentage really messes us up. Payment history is actually one of the most important determining factors, because when it comes to lending you money, these banking institutions, what they want to go ahead and see is that you're going to have the ability to pay them back. They want to make sure that they're actually going to receive their money back. But if they go ahead and see a history of delinquency and late payments, they might not want to go ahead and lend you some money. So if you're just starting off your credit, or you're unfamiliar with how this credit game works, I want you to remember one thing and one thing only: pay your bills on time and pay them in full if you possibly can. I know a lot of us have life going on. We have children. We have this whole crisis going on right now. But by doing little things, say setting up a payment arrangement, setting up an alarm on your phone, or building up your calendar and being aware of when exactly are your payments, pay them on time. You know, you want to be aware of these things, because if you don't pay, even one missed payment can go ahead and lose your balance, lose your way towards building that perfect credit score. So you want to go ahead and keep consistent, build a habit towards paying everything on time. The next determining factor is the total amount that's owed on your balances, which consists of 30% of your whole entire credit portfolio. What this basically means is, how much money are you in debt? Can you pay off that debt? You see, when banks lend you out this money, they're going to look at other banking institutions. They're going to look at the three bureaus and see, how much money does this guy have? Can he afford to pay us back? Is he a risk to us? If so, should we lend him money or should we not? This is why it's really important that you don't go ahead and go over your usage. And by usage, I mean don't use 30% of your credit balance. Now, there's a couple of hacks to kind of maneuver this towards your advantage. And one of them that you may or may not be familiar with is increasing your credit balance. Majority of us, when we're introduced to the credit game, we know that we got to get this credit card, just one credit card. But we don't realize that this one credit card is going to limit us, because what banking institutions do is they see exactly how much money you're responsible with. For the majority of us, if we just have one credit card when we first apply for it, we're going to have a small balance, say of $1,000 to $3,000. For many of you, that may or may not be a lot of money, but to banking institutions, to the loaning institutions, it's very small compared to getting a mortgage, which is why it's always recommended that you want to go ahead and get at least 3 credit cards. because then you can hack the system. Let's say, for example, your credit balance on one credit card is $1,000 and you used 500 of it. Now your credit limit on that has been used to 50% instead of the obvious 30%. But by getting this second credit card or even this third credit card, instead of having $500 out of 1,000, you can have $500 out of 3,000, and now that is about 25% or 30% of the whole entire balance. You see, by getting all these credit cards, banking institutions see, well, this guy has money left over. He's responsible. He's not using all of his money. He's not struggling. So you want to be aware of this, because when you apply for this credit cards, you don't want to be maxing out your credit cards all the time. You don't want to be holding a high balance all the time. You want to keep it really small, and you want to be using it on a consistent basis. You want to be using at least 30% of your credit balance. The next determining factor is the length of your credit, which holds 15% of the whole entire FICO score. The reason why this is important is because, as I mentioned before, the earlier you start, the better. Say for some of us who want to go ahead and get a house by the age of 25 or 30, and we don't start our credit, say, at age 27 or at age 24, then banks and lending institutions only have about a year to see your credit history. But if we say start at age 18 and we decide to get our house at 25 or 30, we have 5 years of showing these banks, hey, I'm financially responsible. I got this. You can let me borrow money. Look at my history. I have this amount of money available for me. I've been paying it off consistently. Give me my house. Give me my car. And make sure you give me a low interest rate on that. That's how it works. You want to make sure you start your credit game early, because it holds 15% of your whole entire score. So for some of you who are trying to figure out, why is my credit not up there? Because you haven't lived much. I know for myself, dude, I'm 23 years old. I still got a long way to go. My credit history, as a matter of fact, I started when I was 20, so I only got about 2 years on my credit report. So these banking institutions see that, but they don't see me responsible yet because I'm not old enough. Which is why I tell all my students, start as soon as you can. As soon as you turn 18, as soon as you get a job, apply for your credit card. A year later, apply for a second one. A year later, apply for a third one, and just don't go into debt. You see, we fail to realize that these older accounts are really, really valuable. When we apply for another credit card and we apply for another one, these banking institutions actually check out that average length. Which is why I tell everybody, the faster you get your credit cards, at least your 3, you wait it out and you start using them and you pay them on time and just wait, these banking institutions are going to see that you're reliable. They're going to give you a better rate and they're going to give you a lower payment. One big tip that I want to go ahead and give all of you is never close an account. You never want to close an account, specifically if it's an older account. Because if you close this account, banks and these lending institutions actually see this as a bad thing. You never want to go ahead and close an account. Let it close by itself. So some of my students ask me like, Professor, what if I don't use that card? Well, look, we all have bills, right? Some of you may have Netflix. Go ahead and put your Netflix account subscription on one credit card, put it on automatic payments, and let it pay for itself. Never touch it again. That's what I do. I have all my credit cards in a drawer. I have them all on automatic payments, and I just put all my monthly subscriptions on there. Because I know that I don't want to go into debt again, and I want to make sure that these banking institutions see me using them, and I get approved for a better loan and a better interest rate. The next determining factor is your credit mix accounts. This holds about 10% of your whole entire FICO score. What do I mean by this? It means what type of accounts are in your credit portfolio. I'm talking about credit cards, I'm talking about your personal loan, I'm talking about a mortgage, and I'm talking about a car payment. You see, when it comes to applying for a loan, these banking institutions actually want to see that you're responsible. They want to see that you can go ahead and pay off a variety of debt. But besides that, just by paying off your credit cards, maybe getting a personal loan, you're able to show them that, hey, look, I'm responsible. But besides that, it only holds about 10% of your whole entire FICO score. But just know that the more accounts you have open, the more of a chance that these banking institutions are going to go ahead and see you as a reliable person. Just don't go into debt. And the last determining factor is new credit, applying for new credit, which holds about 10% of your whole entire FICO score. What does this mean exactly? You see, when you apply for credit, you get hit with a hard inquiry. When you get hit with a hard inquiry, it's reported to these 3 credit bureaus who see that you're trying to go ahead and take on more debt. But if we do this at the same time for a short amount of period, we may be looking to these banking institutions as somebody who's going to a hard time. Somebody who's applying for a lot of credit all at the same time looks desperate. You see, these banking institutions, they don't want to just lend their money to everybody, or else we're going to have the same thing that happened in 2008. What they want to go ahead and see is that they're going to get their money back, that you're going to be responsible and make your payments on time. Although it only holds 10% of your whole entire FICO score, you don't want to be applying for credit all the time. So my suggestion to you is to go ahead and take a chill pill. Don't be applying for credit like crazy. You do not need money, and if you do need money, then you need to budget out. These hard inquiries are going to stay on your report for at least 24 months. After 24 months, these fall off of your credit report. But even then, that doesn't mean you can't be applying for new credit. No, after a certain amount of period, these banking institutions see that, okay, he's not much of a risk, he's not going through some financial troubles, let's give him new credit. Usually about 6, 5, maybe even 8 months, depending on everybody's financial situation. But what you want to get out of this is you don't want to be applying for credit too fast or too soon, because you're going to look desperate. And that's it. That's what completes your whole entire FICO score. That's what makes a good score. If you're falling off on one of these factors, then that's the reason why your score is so low. If you focus on these factors and you try to go ahead and utilize them to your advantage, you're able to go ahead and build off your credit. It's not that hard to go ahead and have good credit. The easiest way to put this, the easiest way to think about it is pay your bills on time. Don't take on too much debt. Don't be applying for credit like crazy. And show these people that you're a responsible adult. That's it. You know, play your game right. There's certain ways that you can use this. There's certain advantages that can help you. Besides that, guys, I mean, getting a car, getting approved for a mortgage is not that hard if you play this game correctly. You want to learn how to build your credit, because when it's time to approve for a house or get approved for a car, you want to get the lowest payment at the lowest rate. If not, you're going to be paying ridiculous amount of money for no reason. Besides that, if you love today's course and if you haven't done so already, go ahead and smash that like button to help me out with the YouTube algorithm so everybody else can go ahead and learn about these determining factors. And if you haven't enrolled into my class already, go ahead and hit the subscribe button as well as hitting the notification button. That way you're alerted whenever I post up a new video. And if you want to go ahead and see more of me, go ahead and follow me on my Instagram, follow me on my Twitter, RisingGrind.mo. That way you can see more of me and see what I'm up to. And I also have another channel called Chris Mo's Journey, where I go ahead and blog about my life, and you can go ahead and see what I'm up to as well. And if you have any comments, questions, concerns, go ahead and put them below, or you can just go ahead and DM me on my Instagram or Twitter. Besides that, class is dismissed, and I'll see you again next time.